Hey everyone, it's Larry Kotlikoff with Economics Matters, the podcast. I'm delighted to be here with my young friend and former professor, Benjamin Friedman. Uh, we've just started a kind of tradition in uh, Economics Matters, the podcast, to have the Friedmans, the entire family of Friedmans, be guests on the podcast. We've had your son John, who's chair of the economics department at Brown, fabulous economist, talk about um, economics of admissions and mobility and the different issues he's looking at, whether affirmative action rulings by the Supreme Court are going to matter to the diversity of the classes in the elite schools and whether going to an elite school matters. So that's a fascinating podcast. I urge everybody to take a look at it. If you go to Economics Matters, Economics Matters, or LarryKotlikoff.substack.com, you'll find under podcast the John Friedman podcast, and it's a fascinating one. But this is going to be equally good, equally fascinating, because Ben Friedman is a professor of economics at Harvard. I was a grad student and took Ben's, remember very fondly taking Ben's class on, where we read the General Theory by John Maynard Keynes in great detail. So Ben's a true scholar in the sense of the best sense of that word, in the sense that he does his homework. And two of the most recent books that he's written, I have in my hand. They're big, okay? They're quite thick. And one's called Religion and the Rise of Capitalism, and that's written quite recently, 2021, and it's got all kinds of acclaim of great short blurbs from people that have reviewed the book, from the New York Times to Nobel Prize winners. Edmund Phelps, one of the top economists of all time, Nobel Prize winner, wrote that it's a colossal work. I mean but then there's pages here of enormous accolades for this book, from the Wall Street Journal, the New York Times Book Review, Washington Independent Book Review. It just goes on. And then we've got this other book we wanted to talk about a bit, that's The Moral Consequences of Economic Growth. And it too has received terrific reviews from the same types of folks. And it's also huge. And here's the cover. And so everybody who's interested in economics would want to, and certainly the history of economic thought, would want to look at these two books, because they're going to give you a tour of economic, intellectual economic thought, and just other, the thinking of others in the general field of public discourse. Now, Ben, let me just tell you briefly, doesn't just write books, he writes articles. I've got his long vita here, sitting here. I decided that we should kind of have this conversation side by side, because I thought that would be a little more fun for you, the viewer. But, if you go to his CV, if you just Google Benjamin Friedman, Harvard, and then you find his curriculum vitae, all kinds of articles, implications of government deficits for interest rates, and we have things like saving, investment, and government deficits, all kinds of articles about lessons on monetary policy from the 1980s. It's just page after page of interesting articles published in top journals. And just as a quick kind of bio, Ben is the William Joseph Mayer Professor of Political Economy and formerly chairman of the Department of Economics at Harvard University. He joined Harvard faculty in 1972. I came as a grad student in 1973. That's when we first met. the latest books I've kind of mentioned. He also wrote a book about fiscal policy called The Day of Reckoning, The Consequences of American Economic Policy under Reagan. He's written like 150 articles in professional journals, published them. He's got, in addition to those three books I mentioned, another 11 books that he's written. And the books are aimed at the public, economists, and policymakers. And Ben has been actively involved in the policy discussions with the Federal Reserve for decades. I'm sure you know every single Federal Reserve chair that's been around since you became a assistant professor at Harvard. And Ben is a Harvard guy. Ben went to Harvard as an undergrad, and he graduated summa cum laude, if I got that right, Phi Beta Kappa. Then he became a junior. Then he got a PhD at Harvard in economics, and then he became a junior fellow at the Society of Fellows at Harvard. That's a very elite category of folks who become assistant professors, but they're so outstanding that they become members of the Society of Fellows. And then you're spending, I think, some time getting a degree from King's College at Cambridge University, where you are a Marshall Scholar. Not everybody gets to be a Marshall Scholar. So, and then you've won some very notable prizes: the Eccles Prize for Excellence in Writing about Economics, the John Commons Award, given every 2 years for recognition of contributions to economics, and the Medal of the Italian Senate. So you are what I've always known to be a big deal in economics. So Ben, welcome, and tell us a little bit about how you got into.
Well, first of all, thank you, Larry. I'm delighted to be doing this. And I have to say that I remember with great fondness the era when you were at Harvard as a graduate student.
Yeah.
You were clearly the leader of that cohort, but it was a good era for the Harvard Economics Department. You were there, and a number of outstanding graduate students who went on to be major contributors to the profession. And I have to tell you, even though it was a long time ago, I remember that era fondly.
Yeah, we had a great class.
It was a great group of people. You were right at the top of it, and you have been a mainstay ever since. So sitting here with you brings back terrific memories from very long ago.
Yeah, we had a great time. It was we had people like the late Sebastian Pinera, who became president of Chile, and just a long list of Ariel Pecas, who's now a professor at Harvard. Nancy Stokey was in our class. She's a full professor at University of Chicago in economics. So quite the list of people. So
it was a terrific era. It was a terrific group, and you were right at the head of it. So
well, I don't know about that, but
sitting here with you is just great.
That's cool. So anyway, tell everybody a little bit about how you where you grew up, and how you came to Harvard and then get interested in economics, and then how you started to focus on monetary economics, and maybe a little bit I think it'd be good to hear, given the importance that everybody's placing on inflation and monetary policy and how much the markets are paying attention to what the Fed is doing, kind of your sense before we start talking about these two very fascinating books, which we'll spend most of the time on. Maybe give us a little kind of background, personal background, but then also background with respect to your thinking about monetary policy. We have quantitative easing showing up right after the crash in 2008, and continuing. We have the modern monetary theory. We have fiscal theory of the price level. There's lots of different conceptions of how money and inflation and prices work together. or evolve together, and what the policy should be and what's really going on. So, and it's different from when I was started, when you started becoming a assistant professor. Uh, and anyway, give us your take on all that.
Well, to begin, how did I get interested in monetary policy? The answer is,
how about how did you get interested in economics?
oh, how did I get interested in economics? I don't have a particularly good answer for that. I noticed some years ago, looking back at the freshman handbook for my class at Harvard, that even before I entered, I had put down economics as my intended major.
Okay.
And I find it difficult to reconstruct how that happened because, like most high schools in those days, my high school did not teach economics.
Which high school?
I come from Louisville, Kentucky. I went to public high school there. It was an extremely good one. I think I got a very good education there. But like most high schools in that era, my high school did not have a course in economics.
Right.
And so I don't think that as a high school senior, I knew what the study of economics was. Well, I don't fault myself for that. I don't fault my high school for it. But then the question, which is what you're asking, is on what basis did I then reply to this questionnaire for the freshman handbook by saying I wanted to major in economics? I don't know.
But when you came to Harvard as a freshman, did you take some course?
Well, I started as a freshman taking introductory economics. It was a full year course, as it is now. And I took the full year course, and as intended, I went on to major in the subject. I found it absolutely fascinating.
Was it your first professor that turned you on to this? Did you recall who that was?
Yes, I do, but I wouldn't give him particular credit. He was an interesting man. The person who taught the introductory course when I was a freshman was a very nice man named Richard Gill, who left economics some years later and became a professional opera singer.
Okay.
Dick was a very tall man, at least a head taller than either you or I. He was a very large man. If you saw him, you might have thought maybe he played in the line for the Packers or something like that. And he had this bass voice to go with it, made him a kind of charismatic lecturer, I suppose. And to repeat, a few years later, he left economics altogether and made a career as a professional opera singer. I remember him as a very nice guy, but do I credit Dick Gill for my interest in economics? I don't think so.
Okay.
I don't think so.
So then you go through.
So where did this come from? But the point that I did want to make is that even from the very beginning, I was always interested in what you and I call macroeconomics. In other words, the behavior of whole economies and how to influence whole economies rather than looking at the decisions of individual people, individual families, individual firms, what our colleagues call
the big picture. The big picture.
Yes, that's right. And also, I was always interested in it from a public policy perspective. And there, I think I would give the Harvard Economics Department credit because, as you well know, and as has shown up at your work too, our department has always had a focus on policy. And your interest in policy has been different in mine. You've been more interested in things like Social Security and retirement and things like that. And I've been more interested in macroeconomic policy, monetary policy, fiscal policy, government deficits, borrowing, spending, taxes, interest rates. But nonetheless, I think you and I both have this focus on public policy that I would attribute to the orientation of our department going way back. And from what I understand, it was there before you and I got there.
Right. Now, tell us about your kind of interest in monetary economics, how that, okay, we know that's what macro policy, including monetary policy, interests you. But take us back to you're kind of thinking about and understanding and discussions with policymakers in the 70s and then beyond up till today. Do you give us a little kind of a path through the past?
Well, to begin, I was always interested in financial markets anyway. And so I think the aspects of public policy, macroeconomic policy, that interest me have primarily been the ones that intersect with financial markets. So in my work on fiscal policy, for example, it's not an accident, I think, that what interested me primarily was issues of having to do with government borrowing and debt, because that takes us to the bond market.
Right.
In monetary policy, we have the Federal Reserve implementing policy in a way that operates through the banks, but also, again, through the bond market. And by accident, I think, and here we are in the world of happenstance, when I was in graduate school, I had an unusually large number of opportunities to interact with the Federal Reserve. In the summer, in between my 2 years at the other Cambridge and coming back to Harvard, I worked at the Federal Reserve Bank of New York. And shortly after I arrived at Harvard, one of the professors in our department, whom you'll remember, Jim Dusenberry, got me an assignment as the special assistant to the president of the Federal Reserve Bank of Boston. In those days, as today, the presidents of Federal Reserve banks sit as members of the Open Market Committee, which decides on interest rates. And in those days, they met once a month. Now it's 8 times a year. So there was this very warm, well-educated, interesting man named Frank Morris, who was the president of our Reserve Bank here. And every month he would have to go to Washington and express what he thought about interest rates. Well, he needed some help, and Jim thought I might be able to help him. And so all the way through graduate school, I worked for Frank, helping him with his monetary policy decisions. And then there were 2 summers when I worked at the Board of Governors of the Federal Reserve. And the assignment that I had in one of those summers was working on a special subcommittee of the Open Market Committee, in which they were redesigning their procedures. So by the time I graduated with my last set of degrees from Harvard, I had idiosyncratically, luckily, a lot of exposure to the Federal Reserve system.
Kind of like a vocational school at the Fed.
Well, I think that's a good way to put it. I had all of these opportunities, and I met the people. Meeting the people, is very important, because then for years after, when I had a question about things, I could pick up the telephone and I knew whom to call. And moreover, and I wouldn't ignore this aspect of it, I have to say I liked these people. They were good people. They were dedicated public servants. They wanted nothing other than to do their best to get it right, and I admired that. And if I had been there at the Federal Reserve and come away thinking, well, these are just not my kind of folks, I probably would have done something else. But that wasn't my reaction. My reaction was the opposite. I thought these were terrific human beings, in addition to being fine economists. And I said, interacting with these people is what I want to do.
I was just parenthetically, I was spent a summer as an intern at the Board of Governors in the research department. I guess it was the International Economics Research Group at the Fed in DC. And to this day, I think I learned, it was just an incredible group of people. They weren't necessarily, people at the top 5 departments, but they were had very eclectic views about how things worked. Everybody disagreed with each other. But here you are, 1972, you become an assistant professor. Inflation starts to take off in the 70s. Arthur Burns is the chair of the Federal Reserve. Paul Volcker becomes chair. And, and then we have this big recession. It wasn't called the Great Recession, but was essentially as great as the Great Recession. Unemployment goes up 10% in 81, 82.
It was actually back-to-back recessions, to recall. There was a short recession
and then it goes
in
up,
1980, followed by a much longer one in 81 and 82.
Right.
Very short interval between.
So it's kind of like today in the sense that, well, it was higher inflation, well, I guess, yes, somewhat higher inflation for a longer period of time. Interest rates shoot up. They shot up. Short-term rates shot up to like 22%, I believe.
Under Volcker, that's correct.
Volcker. And then it takes a long time for them to come down, because I think the people that got burnt having lent money at low rates didn't want to get burnt again. So I think part of the reason that interest rates today are high is that there's a kind of inflation insurance premium built into these interest rates. I don't want to lend you money, get paid back in watered down dollars. So even though I see that the inflation rate has come down and it's running like 3.4% as of today, on a retrospective basis, going back the last 12 months, it's cumulatively 3.4%. I know it was recently up to 8% on an annual basis, and I don't want to be there lending money to you for a long-term basis and get paid back in watered down dollars. But anyway, so we can see these high interest rates, and we have Volcker come along and decide that he's going to follow Milton Friedman's advice, which is to target monetary aggregates. He announces.
Well, I don't believe that. I don't believe that for 1 minute. That is not what Paul did.
Okay,
and
I know he doesn't do it. I mean, that was going to be part of my question, which is
no, that is not what Paul did.
But he said he was going to do it.
That isn't what he said either. What he said was, and again, Milton Friedman was a very interesting economist who had many things to say. And so to the extent to which Paul Volcker followed Milton Friedman's advice depends on which piece of the advice you have in mind.
Okay.
The first magnitude thing is that Milton was very focused on inflation, and Paul was as well. So if that's what you mean by following Milton's advice, absolutely Paul did it. Paul came into office understanding that inflation was a terrible problem. It was a terrible problem for the United States and for virtually all other countries in the economically advanced world. And moreover, he understood that by the time he got there, it was a chronic problem. This was not a matter of something getting out of hand in this business cycle or that expansion. Paul became the chairman of the Federal Reserve in the early 80s. Inflation had been picking up and had been becoming increasingly problematic since the late 60s, not just here, but everywhere. And so he understood it was a chronic problem and had to do something about it. Now, what you said that he did not do was target monetary aggregates. He did not do that. He said that what he was doing was pursuing a target having to do with the reserves that the banks hold at the Federal Reserve, so-called non-borrowed reserves. But even there, Paul was honest that that was just a dodge. He was looking for some way to get interest rates up to the extraordinarily high levels that you described.
So I would say I would characterize it as he announces something. Maybe he doesn't announces targets for the monetary aggregates. Tell me if I'm wrong.
No. Again, he announced a target for the non-borrowed reserves of the banking system.
Okay, but then interest rates immedately spiked.
Yes, they did.
Like 10 seconds later.
Yes. And he knew that would happen. He knew that.
So, so there's lots of interesting questions. I mean, Friedman was saying, we have this, growing inflation over this period, then it gets high, it becomes endemic. Friedman, I think, is focused on the monetary aggregates.
Yes, he was.
And saying, look, if you print more money, you're going to have inflation. This goes back to his history with Anna Schwartz of monetary economics, or I guess monetary history of the United States, his classic book that he got the Nobel Prize for.
Actually,
So
that's not correct. He got the Nobel Prize not for that, but for the book on the consumption function.
oh, okay.
Very different lines of analysis.
I see. Okay. Anyway, so what is your take, at the time and now today on what actually led to the inflation that Volcker comes in to try and stop in trying to talk the market out of inflation expectations into a different conception of what's going to happen in the future, and basically panics the financial markets, interest rates go up, they think they're going to be short on liquidity, and we go into recession. And he basically gets inflation out of the system by putting us into recession. But what do you think led to the inflation, not just in the US, but worldwide? It's not what Friedman thought or said at the time, I imagine. That's not your view, or maybe even Volcker's. What do you think was the explanation?
I think there were two elements of it. One is that for some years, we had been running the economy at too high a level. You could think of that in terms of unemployment being too low for inflation to be sustainable, but I think just looking at the unemployment rate is too crude a way to do it. I think just broadly construed the demand in the economy over a series of years, going back to the Vietnam War period. It's not an accident that all of this started up in the mid to late 60s. If I tell you that an economy whose country fights a major war has some inflation either during the war or immediately afterwards, sometimes as in World War II, we and lots of other countries had price controls to limit the impact on inflation. But if I tell you that during and immediately after a war, an economy typically has some inflation, I'm guessing this isn't going to surprise you a bit. Well, starting in 1965 and then right up through 68, we had an increasing amount of mobilization of our economy and our manpower to fight in Vietnam. This turned out to be very costly in a whole variety of ways, one of which is that we did not take steps to restrain the domestic economy. And so putting together the war effort and the high employment domestic economy, there was much too much demand for what the economy
So let me put it in maybe a little bit more conventional or layman terms, people terms. The government is spending more money. It's not presumably raising taxes. We've had the Kennedy tax cuts. I don't recall any major tax increases.
There was a tax surcharge finally in 1968, but it was small and temporary and inadequate.
So you're saying we're kind of deficit financing this war.
Correct.
Leading the household sector to want to spend what it was otherwise going to spend because their taxes haven't gone up. The government sector is spending more to buy military equipment and so forth. And then we have on the supply side, we have a lot of people going into the military who would otherwise be out there producing goods and services, and they're out there in the in the Army, Navy, and Air Force fighting. So they're not available to. So we have a shortage. So we have these two factors leading to price increases. So you don't think it was a monetary phenomenon? You think it was a fiscal phenomenon?
It was a monetary phenomenon in the negative sense that if the Federal Reserve had aggressively pursued a tight monetary policy during those years, then all of that spending by ordinary families and businesses that we're talking about would not have happened. So could monetary policy have blunted the inflation? Yes, they could have. Did they do that? No, they did not. In that sense, the inflation that occurred was the fault of monetary policy. But it was not monetary policy actions that initiated the process. It was a monetary
Right.
policy mistake in the sense of monetary policy not resisting the inflation. But then there's a very important second issue that I want to make sure we include, and that is that in 1971, the oil producers cartel, OPEC, quadrupled the price of oil. Oil went from $3 a barrel to $12 a barrel in the dollars of those days, and that was a lot. And then in 1974, the oil producers tripled the price yet again. So 3 times 4 is 12. So this means that over a period of 3 years, the price of this very important commodity, important for production, important for consumers, everybody's filling up their tank at the gas station. Airplanes have to fly on gasoline. We don't have any alternative to that. This very important commodity increases by a factor of 12, and this has ripple effects right through the economy. So I think if you put those two together,
Right.
the excess demand running through the economy, and then plus, as economists called it at the time, this supply shock from the oil price, then I think you get the makings of this very chronic inflation.
And then, we have other prices that could have dropped, keeping, the neoclassical view would be, well, if this price goes up, it doesn't mean that the other prices go up, they could go down, but we have an increasing sense over time in the world of macroeconomics that prices are sticky, increasing, I guess, evidence.
Say that the view you articulate that if this price goes up, some other price can come down is correct but foolish.
Because of sticky prices.
Yes, and also because relative prices aren't able to move that much. I gave you a moment ago the example of airline prices, of airlines. Now, you could say to whoever was running American Airlines and United and the other carriers of the day, TWA, which no longer exists, you can say, oh, yes, yes, the price that you pay for the gasoline on which the airplane runs has gone way up. But we expect you to lower the price of the ticket in order to keep
Right.
inflation overall from going up. Well, the head of American Airlines is going to say, oh, this is all very nice, but I'm supposed to make profits, not losses. And if the gasoline price is going up and I'm supposed to charge less for the price of a ticket, that doesn't mean a profit, that means a loss.
Okay, but if the price of the airline ticket goes up, I should be, as a consumer, shifting into taking fewer trips and well, because I'm poor in general, I'm going to buy less in other goods and services, and those prices should drop, and they didn't.
I understand, and in the fullness of time, perhaps this works out, but neither you nor I can come up with an example of when it has.
So
that's what I mean by saying this idea is correct but foolish.
Okay, so this is kind of getting at kind of why inflation can take off from a fiscal side, nothing having to do with the government printing money, which would have been Friedman's conception. The government's just printing money, and going back to the old quantity theory of money, money times the velocity of money equals the price times output. So if money goes up and output is the
all of that is just silly business. But
right.
What you said that is correct is that if the monetary policy had resisted,
right,
then the inflation would have been blunted and gone away much faster. So
okay, but when you say this is silly business, I mean, this was, some people were thinking this and still do back then, that we should have kind of that the economy is neutral fundamentally to money, and you're saying that may be true in the long run, but not in the short run. And I think that's something that people became convinced of, and certainly you and I are convinced of that. But it took a while. I mean, if we go
Yes, I
back,
think that's right. I think there was a new line of thinking that held, as you just said, that the economy is neutral with respect to money, which is to say, if the Federal Reserve raises interest rates a lot or does something with else, it's not going to affect real economic activity. It's not going to affect production or employment or spending. It's only going to show up in inflation. Now, today, nobody believes that. If you listen to people talking about whether the Federal Reserve is going to raise interest rates yet some more or cut them, and maybe there's going to be a recession, maybe not. Why would there be a recession? Why would anybody even raise that if money were neutral, monetary policy were neutral? Well, the answer is that it isn't. I think that was a very damaging line of research. Bob Solow, one of the great economists of our era, who just died, alas, last fall, put it the way Bob put it was that that line of thinking set macroeconomics back 30 years.
okay.
I think he was right. I think that line of thinking became influential. It was wrong before it became influential. It was wrong while it was influential. It remains wrong now that it's not influential.
Okay.
But the sad fact is that it did become influential. And as Bob put it, I think it set the field back 30 years.
So here you are. We had inflation taking off in the 70s. We have Nixon who puts on price controls. We have then Carter.
Terrible mistake.
Yeah, Carter comes in, puts on his price controls, and then Volcker comes and engages in this perhaps psychological feint that scares the entire financial world, and interest rates go sky high. Everybody gets the sense that this is going to put the economy into recession. I start maybe laying off my workers because I think you're laying off your workers are my customers, my workers are your customers. The whole thing ends up with 10% unemployment, which is what we saw in the 2008. But here we're talking about 1980s, early 1980s. Would you have done something different back then? How would you have, was this kind of a series of, did Volcker overreact? Did the market overreact? I agree the price controls were not the answer. Should there have been some more jawboning and saying, look, we're going to head the economy down this path of getting back to 2-3% inflation. We can do it one of two ways. Everybody can come on board and raise prices by 2 or 3%, or we can have a recession. What would you like? And try and get everybody on the same page. How would you have acted had you been Volcker at the time?
I would like to think that I would have had the courage and fortitude to do what Volcker did.
Okay.
I thought at the time, and I think now that Volcker got it exactly right. Volcker was dealt a very tough hand. There were a lot of mistakes that the Federal Reserve made. They were not made under Volcker. They were made under his two predecessors, Arthur Burns, whom you mentioned, and Bill Miller, who was there very briefly in between Burns and Volcker. And the monetary policy during that period was not good. But by the time Volcker arrived with the hand that he was dealt, with the legacy that he had from, and I want to keep emphasizing, it wasn't just the monetary policy mistakes, they mattered, but it was also the Vietnam War, the failure to try to contain demand in the economy during and after the Vietnam War, the oil price increases. Given that all of that had happened, I think Volcker got it exactly right. You ask me, how would I have handled it? I'd like to think I would have had the courage to do what Volcker
So this is
did.
like a sledgehammer to the economy.
You could call it that. It's taking bold, aggressive action that not only put a clamp on demand, which it did. You mentioned the 10% unemployment. That's correct. But I think you also are right that it arrested people's attention. People understood that we were in a different regime. People understood that policy was no longer going to accommodate all of this inflationary development. I thought Paul got it exactly right. And incidentally, he got it right over the pressure of the Reagan administration to try to get him to stop. There's a very important episode in his memoir. Many of us think that he wrote the memoir specifically so that he could get onto the public record this episode. Paul reports that he was summoned to the White House. He went. He's ushered into a room. The only two people in the room are Reagan and Jim Baker. Baker was the chief of staff. Baker took out a piece of paper. Reagan said nothing, according to Paul. Baker took out a piece of paper and started reading and said, "The President of the United States orders you to reduce interest rates." I don't know if you've read Paul's book. And do you know what Paul did?
No, what do you do?
Paul, knowing that the President of the United States did not have that authority, said nothing. He simply stood up, walked out of the room, and went back to his office. Now, would I, Ben Friedman, have had the courage to behave the way Paul Volcker would? Well, in my dream of dreams, I admired Paul greatly. I would like to think that I would have had that kind of courage. Do I know that I would have? I don't know.
Okay, so now let's just kind of speed along through the rest of the years up till the present. We have our current inflationary episode, which is also, demand driven, supply driven, not all that different in some ways from because of all the stimulus to respond to COVID, not all that different from what you're describing.
Well, that's right. I think of the pandemic experience as very much like a wartime experience, that there were all sorts of disturbances on the supply side of the economy, all sorts of industries more or less shut down. There were dislocations on the demand side. Remember, there was a period in which there was a massive shift of demand from services to goods. Nobody wanted to go to the movies anymore. Everybody wanted to buy some piece of household this. And then after the pandemic ebbed, then massive shift back from goods into services. All of a sudden, everybody wanted to travel and stay at hotels. In the meanwhile, as you point out, in order to keep people from being unemployed, there was massive fiscal stimulus. I think of it as just like a war. And in the same way that we're not entitled to be surprised if an economy that goes through a war has some inflation, we're not entitled to be surprised that the pandemic led to some inflation. It did.
Okay, so what about the monetary? So we had inflation, but we didn't have the kind of policy that Volcker engaged in. We've seen higher interest rates, but not sky high. So you're saying,
well, and we also haven't seen the kind of inflation we had in the 70s and early 80s either. I think the monetary policy has been pretty good. I thought the Federal Reserve was too slow before the pandemic to raise interest rates. I thought the economy was operating at a very high level. Unemployment was very low, and the Federal Reserve back in 2019, 2020, early part of 2020, was slow to raise interest rates. But these are judgment calls. I wouldn't complain about it a lot. Once the pandemic hit, I think they've done very well.
Okay, so you're looking for as kind of a soft landing through the into the next year, let's say.
I don't know if we're going to have a soft landing because you know as well as I that it's highly unusual for a major economy to get inflation down without having a significant period of economic weakness.
I see. Okay.
Now, will we have enough economic weakness to that people will say, oh, no, no, then the landing hasn't been soft? I don't know. Nobody knows, but I would not be surprised if we have some economic weakness. But I think the Federal Reserve is hoping I think they're very committed to, I talk to these people, you do too. I think they're very committed to getting inflation down. And if it takes some economic weakness, well, it does.
I got it. So let me get your quick take on some probably very different views than you have about monetary policy and the way money works in the economy. So let's start with a modern monetary theory. What do you make of that?
I can never figure out what it's all about, to be
Okay.
very honest with you. The grain of truth in it, as I understand it, is that if interest rates are super low, it's okay to borrow. Well, and a question that I pose to my classes when I teach about this is suppose somebody is offering to lend you in the mortgage market unlimited amounts of money at a zero interest rate. How big a house do you want to buy? That turns out to be a very tough question. So I think there's a grain of truth in the modern monetary theory, but like so many other of these crazinesses, if I can call them that, and we talked in more substance about the one 50 years ago when all sorts of people persuaded themselves that monetary policy didn't affect production or spending or employment. What often tends to happen, I think it's a real flaw of our profession, people grab onto some grain of truth that's true under some circumstances or over some horizon, and they persuade themselves that it's always and everywhere true. What an unfortunate phrase we have in our profession. People say such and such is always and everywhere true. Almost nothing worth knowing is always and everywhere true. And I think modern monetary theory fits the description.
So, okay, let me ask you one other related question, which is the fiscal theory of the price level, which
Same thing.
okay, let's maybe just explain that to so modern monetary theory, maybe we should kind of step back and say that it's a view that the government can basically print as much money as it wants to pay for its bills without concern unless inflation takes off. So it could print a whole lot more money without any real consequences. And
let me just interrupt you. You keep using this phrase, print a lot of money.
okay.
I think that's a very bad phrase to use because you and I know what it means. It's shorthand for a process in which the central bank allows the private banks to lend to customers. And the way they lend is to create a deposit.
Right.
That's what it means. You know that, I know that.
Right.
But my experience is that when we talk to people who are not trained economists, when you talk about printing money, they actually imagine some Germany 1930s phenomenon in which hidden in the bowels of the Federal Reserve building in Washington is a big printing press, and they're running off green pieces of paper to hand out. That's not what they're doing, and it's different, and it's importantly different.
Yeah, okay, we don't have printing presses to the extent being printed, we don't have that much cash in the economy. We have electronic money, but
it isn't about electronics. This was true before the era of electronics. To the extent that money is being created, it's the deposits that the banks are creating
Okay.
as
Well,
the
let me take you
counterpart
through this.
of lending their
Suppose-
customers money.
Suppose um, the government cut taxes to zero, okay, and kept them there for a decade, and the Fed and issued bonds, and the Fed bought up the bonds. Uh, that would be, I would think you would consider that to be monetary finance of government spending.
Correct, because the
Okay.
Federal Reserve is buying in, you said it just right, the Federal Reserve, in your example, would be buying in the securities that the Treasury is issuing.
Yeah.
Exactly.
So that's going on through these years, even in recent years, and that's called monetization of the debt. And we also have, how does that fit into your thinking about recent inflation? We have had large increases in deficits, and the Fed has bought up a lot of government paper, but then, of course, it's also paying the banks to, so it's issuing it electronically buys the paper, and then it has the banks deposit those reserves with the Fed and pays interest on it. So it's not so clear that there's real monetary finance going on here.
That's correct.
Is that a fair statement?
There is monetary finance in the sense that the Federal Reserve is buying a lot of the Treasury debt. Today, the Federal Reserve owns government securities in the amount of about $6 trillion. If we go back to
this is where people talk about its balance sheet expanding.
That's correct. They own about $6 trillion of government securities, and they own about another trillion or so of mortgage-backed securities. So the balance sheet as a whole is about 7 trillion. Now, how do they buy these? The way they buy these is to credit the banks with reserves. So you're a bank, you're the JP Morgan, and you sell the Federal Reserve a security. The way they make payment is to say, thank you, JP Morgan. You now have extra reserves that you did not have yesterday. If that were the end of the story, this would be monetization of debt in the old-fashioned sense, which would be inflationary. Why? Because with those extra reserves, JP Morgan would be able to lend a lot more to its customers. And on the strength of that lending, they would spend more, they would invest, et cetera, all the usual inflationary process. But there was a very crucial change made at the end of 2008. And that is that in 2008, the Federal Reserve moved with congressional authorization to a new system in which they are able to pay interest to JP Morgan and all other banks on the reserves that the banks hold. And what they have done is, in effect, deactivate or sterilize those reserves by paying a slightly above market interest rate to the banks for holding those reserves inactive on deposit at the Federal Reserve rather than lending them out. So in effect, the Federal Reserve is at one window putting out the reserves and at the other window taking them right back in.
Largely, so this gets us to quantitative easing. You view this as basically cosmetic.
No, I don't, because the fact that the Federal Reserve is taking those bonds off of the market by buying them is meaning that the market is moving to a lower interest rate. The standard estimate would be that by pursuing quantitative easing, the Federal Reserve lowered the Treasury bond rate by about 0.5 percentage point and lowered the rate on mortgage lending by about 0.75 percentage point. And was that expansionary? Yes, I would think so. Was it not? Was it hugely expansionary? I don't think so. but it's not as if it didn't mean anything. But that's the way the quantitative easing helped the economy, if it did help.
Okay, so this has all been I think, tell us just a little bit more about the fiscal theory of the price level, what it is and why you think it doesn't make sense or doesn't hold water.
I think it holds up in the very long run. The idea, and here I'm probably not the best person to give you an explanation, but my understanding is that in the long run, if the Treasury issues enough securities, those will have to be bought in by the central bank in one way or another. And when the central bank buys them in one way or another, that will lead to enough creation of private money and credit that the economy will overexpand, so that in the long run, under all of the assumptions, like the Federal Reserve is not doing what you and I just described as putting out the reserves at one window
And
taking them right back on the other window. If you make enough assumptions, then in the long run, the idea is that what drives inflation and prices is the amount of borrowing that the Treasury has done. And I can imagine circumstances in which, in the long run, this has some truth to it. As I was saying before, what's frustrating about so many of these bizarre economic ideas is that they all start with a grain of truth. There's a kernel.
We have seen, so basically, let me say it in a slightly different terms, that if you have the government spending a lot on transfer payments for Social Security and welfare payments and defense spending as it is, and foreign aid, which we've increased dramatically of late for Ukraine and Israel and Taiwan. And then you have taxes and running large deficits, and then we're running, kind of off the book deficits in the form of Social Security's unfunded liability getting bigger and bigger without addressing it. And so you have all the kind of a fiscal gap for the country that's not sustainable. So we're off the government's intertemporal budget constraint, as we would call it. So then the question is, how does this get paid for if you're not going to get any more real taxes than you're now projecting? And we know from the Congressional Budget Office, they have projections of debt to GDP ratios. The government just borrowing more and more, debt to GDP ratio going up to 200, 150%, 200% of GDP. It's now about 100% of GDP. And then people thinking about that say, well, the only way this works out is if the government, in effect, raises taxes, the monetary authorities raise taxes on their own by, and I'll use the terms printing money just because it's conceptually easier for people to think about, by putting out.
It's conceptually easier, but it's wrong. Okay. It is wrong and it's misleading. Okay. And so you should not do that.
A different mechanism. Okay.
When you talk to non-economists, you should not do that. Talking to me is fine. You shouldn't mislead the public.
Okay. How would you want to think about it? You want to think about it as them not sucking the money back in, that they monetize the debt, and then it gets
all that is surely correct. Now notice.
So that's just an argument over mechanism.
That's right. Yeah. Notice that you said a lot about fiscal policy and not monetary policy, but that's, again, it's called the fiscal theory of the price level. And again, in the long run, that is surely surely true. What the mistake that people make, and this goes back to what we were saying about the monetary neutrality idea. The mistake that people make is to think these things are true over shorter horizons. Think about government debt and all that in inflation in the period from the great financial crisis or recession of 2008 up until the pandemic. That was a period of a dozen years, and the government did a lot of borrowing during that period. And what happened to inflation? There wasn't any. There wasn't any. Throughout that entire period,
Right.
the great problem for the Federal Reserve is that for one reason or another, I didn't think it was a good idea, they said they wanted to target a 2% inflation rate, and they could not get inflation to be as fast as 2%. Well, despite all of the government debt being issued. So this idea that is surely has some truth in the long run failed to apply at all over a 12-year stretch.
Right. And just to be clear to the fiscal, or be, let's say, fully descriptive of the fiscal theory, the adherence to that, view is that if government policy is on a path where it's just not sustainable, the spending's not sustainable with the tax path that is being pursued, that the inflation would happen immediately, and that, or that let me put it this way, the prices would jump up, not necessarily on an ongoing basis, but would jump up immediately so that in anticipation of that path, and therefore would water down the real value of the government debt, and that's the way the correction would occur. Now, it could, of course, occur in other ways, which is we can cut Social Security benefits, we can cut other kinds of spending in the future, we can raise taxes. So this makes the entire kind of prediction of what's exactly happening very much, and what should be happening to prices, and what's the relationship between monetary and fiscal policy, all very contingent on how you think about future policy. And that makes this a very difficult subject. Is that fair?
And the question, and then it makes you use the euphemism difficult. The question is, after you go through all of the things which you just said exactly correctly, is there any practical value to this set of ideas? And I would suggest no.
Okay. Well, let me just get to your books. One of your books is about, sorry, we're taking perhaps too much time on this, but I think it's been
No, I think we've had a very useful discussion. And I think if we educate some of your listeners, I think we will have done a good morning's work.
Okay. So you wrote a book about, one of your books is about the debt. And this was the book before Religion and the Rise of Capitalism, and you're very concerned about that, the moral consequences. No, that's not that. Remind me the name of the title of the book.
Well, which one? There is a book on debt, and there's a book on the book on debt was called Day of Reckoning.
Day of Reckoning.
Which was a quotation from Ronald Reagan, and it was meant to be ironic. When he was running for president, Mr. Reagan pointed to the government debt and deficits that we had and said, well, this can't go on. There has to be a day of reckoning. That was his phrase.
Right.
And then Mr. Reagan took office, and there was the large tax cut in 1981. And it was together with a defense buildup. And importantly, people forget this, Reagan was very firm that we were not to cut entitlement spending. In the first week of his presidency, Reagan issued an order that 7 programs were not to be touched in any spending cuts. One of those was Social Security, and one was Medicare. Those are the 2 big entitlements. So it was the Reagan fiscal policy that then put the United States on an unsustainable path, which might have implied some kind of day of reckoning. And the title of the book, incidentally, I don't take credit for this. people like me don't get to pick the titles of our books.
Right.
I
Okay.
don't know whether you get to pick the titles of your books.
Sometimes not.
I don't get to do that. But my editor at Random House picked that title, and I thought I could have vetoed it, but I thought it was a fine title. And the idea was that it was this combination of massive tax cuts, large increases in defense spending, and refusal to cut non-defense spending that did put the economy on an unsustainable path. And what the book was about was describing for people how this situation of US fiscal policy would work out if not corrected.
And do you think we're in that kind of situation where it hasn't been corrected? And at least in my view,
I wouldn't say that. It was corrected, and now we've gotten there again. It was corrected because in 1993, under Clinton, there was a significant tax increase. In 1995, when the Republican majorities took over in Congress, there was a significant amount of spending cuts. Some of those spending cuts, incidentally, were in defense because in 1991, the Soviet Union had collapsed.
Right.
So defense spending went down, but the Republicans in Congress cut a lot of non-defense spending as well, not the entitlements, but they cut the other spending, so that by the time we got to the end of the Clinton administration, not only did we not have large deficits, we didn't have deficits at all. The government was running surpluses at the end of the Clinton administration. And so when you say, are we still on that trajectory? I wouldn't use the adverb still. I would say, again, we corrected the problem by the end of the last century. And then the younger Bush came in and we had some rounds of tax cutting. Then Obama arrived and we had some spending increases. Then Trump arrived. We had some more round of tax cutting. And then it's tough to know what would have happened under Biden, but with Biden and the pandemic, we had more spending cuts. So today, I think we're right back where Reagan put us in 1991.
So I guess my view of the history is different because, the official debt is just one, is debt that's on the books. There's this debt that's off the books, like the unfunded liabilities for Medicare and Medicaid and Social Security and other commitments, including defense spending into the future, that aren't, these are debts that are not official. And yes, you could think about, hey, we can cut Social Security benefits. We now have a $63 trillion official, according to the Social Security trustees report that just came out about a week ago, unfunded liability. That's 2.2 times the official debt. And that was growing during Clinton. The unfunded liability for Medicare benefits increased by a quarter under Clinton. So that meant that everybody coming along was going to get into the future, get much higher Medicare benefits. And none of it was, covered in terms of some trust fund or some higher increase in taxes on the current elderly who are going to benefit right away from these higher payouts. So I think the fiscal policy has gotten worse and worse and worse.
Well, I would go along with that, and you and I have discussed this before. The place where I depart from your thinking is not whether these future liabilities, what you call the unfunded liabilities, matter. You're exactly right. They matter. But I don't draw a big distinction between the future liabilities in these entitlement programs and other future liabilities. Every time the government puts an aircraft carrier on the water,
has to repair it, right?
It's not just that they spend some money to build the aircraft carrier. Once that thing is in the water for however many years, you know the government is going to be spending a lot of money to keep it afloat and keep it staffed and
Right.
keep all those sailors on it. And you can say the same thing for the defense establishment. You can just go right down what the government does. Think about the road system, the interstate highway system, going back to Eisenhower. It's not just that they spent some money to build the highway, they are then committed to maintaining the highway. So the only place you and I differ is that your discussion of this always focuses on the liabilities, which, as you rightly point out, are a kind of formal commitment. Whereas I think about all of the other things that we know the government is going to have to
Yeah.
do, and they should fall in the same category.
Yeah, I've been pushing for years, as you know, for doing fiscal gap and generational accounting at the official level. And there was actually a bill uh, that was introduced by 8 senators, 4 Republicans and 4 Democrats. That's all the support it could come up with to do a full, to do accounting that's not short term but long term accounting all the time for every bill. So that, and also connected with that, the generational accounting, which says how much of this unfunded, this fiscal gap that we're facing, if all the promises we're making and all the obligations to keep the aircraft carrier afloat do get spent, do get paid, how much of that burden is going to land on future generations, on our kids or grandkids, if we don't raise taxes on current generations. That's generational accounting. And I think that picture is getting worse and worse. And even though official debt may in certain periods have gone down, the overall picture. But let me move you to these other fabulous books. I think one thing people are hearing in this conversation is the depth of your knowledge of the institutional realities of how things actually work, but also the players. But then you have spent, years being a true scholar and looking back at history of economic thought and political thought and outcomes and events. And you've written these 2 books, and we have to talk about them before we bring this to a close. Tell us first about the moral consequences of economic growth is about, if I am expressing it correctly, summarizing correctly, the fact that when growth slows down, people become uneasy and they start worrying about themselves more than anybody else. And then you have people becoming post-immigration, democracy becomes less of a concern or less of something that people are willing to accept. It becomes more of a fight over a fixed pie rather than collectively trying to make a bigger pie.
I think you summarized it very well.
Okay.
I accept. That's a great description.
Is that a great description? Now, tell everybody why they should read this book. I mean, how far back does this go? This is a thick book, and the reason it's gotten so many accolades, and it was written in 2005, but it doesn't mean it's any, it could have been written today because it's
well, and some people keep urging me to bring it up to date. The main relevance for today is that when economies enter periods such that the broad bulk of the population experiences a stagnation or worse in its material living standard, then all sorts of bad things happen. People become less generous. People want to hoard opportunities for themselves and their children. All sorts of strife comes out. You mentioned anti-immigrant agitation. There are things like religious religious conflict, racial prejudice and conflict, commitment to democracy itself wanes. And I think the relevance of this is that this has not been a good quarter century for the United States. On average, our gross domestic product has increased at a not terrible rate. Not been great, but it hasn't been terrible. But the widening of inequality over this
But
period,
wage inequality in particular, yeah.
well, I don't care about it.
And
Not just income inequality from whatever source, what people have to pay for their groceries and the rent. Income inequality in America has been widening during this period to such an extent that with the modest growth we've had, the majority of American families have experienced economic stagnation of a magnitude that corresponds to some of these episodes I've looked at in prior periods, like the 1880s and early 1890s I looked at in the book, like the period between the two wars I looked at, the Great Depression, like the period in the 1970s and on into the 80s. And sure enough, what I do in the book, in the American section, is to go back and document that during these episodes, when the public experiences this kind of protracted economic stagnation in its living standard, then all of these phenomena like anti-immigrant agitation and cutting back on generosity and being less dedicated to democratic institutions, all of this stuff comes out of the woodwork. And I think we're there now.
So I think, so this, let me just remind everybody, this is the book. It's called The Moral Consequences of Economic Growth.
Incidentally, if I were rewriting the book now, I would call it The Moral Consequences of Economic Growth or Stagnation.
Right.
Because the title suggests that the future is one of economic growth. And maybe that was something I thought in 2005, but who would confidently predict that today?
So I look at the back cover. The Washington Post says hugely provocative. Foreign Affairs says a major work. The kind of reasoned analysis is precise. This kind of reasoned analysis is precisely what is necessary to put the United States back on the right track. I think the key point here is that this is like a Gedanken piece. This is a kind of a view of the evolution of politics and economics, the interconnection between the two, and policy that really it's a whole different conception. It's an eye opener, and I applaud you for this. I think it's it's opened my eyes just reading the beginning, and I still have the whole rest of it to read. Now, let me talk before we head off about religion and the rise of capitalism. How do you come to focus on that? And this book is kind of a history of economic and political events. This is a history of economic thought.
The one is about events, the other is about ideas.
Yeah, where you learn an enormous amount about the different players, and Adam Smith and Ricardo and Alfred Marshall, and it goes back. I'm seeing, open the page, you got references to Spain's King Philip II, who 30 years earlier had been King of England when he married Queen Mary. No, I don't think anybody knew that the King of Spain had been the King of England.
If his wife hadn't died, he could have been King of England.
So this is the fascinating part of this, whether or not you buy into exactly Ben's view of the connection between religion and capitalism, you're going to get an enormously interesting history of thought, not just economic thought, but philosophical thought. Tell us a few things about this book. How would you summarize this book?
This book is aimed at rebutting the conventional wisdom, as my dear friend Ken Galbraith would have put it. The usual view is that because economics, as you and I practice it, is a discipline that grew out of the Enlightenment of the 18th century, and because we think of the Enlightenment as a movement away from thinking in terms of a God-centered universe to what we in our modern vocabulary would call secular humanism, the usual view is that therefore follows that economics doesn't have anything to do with religion. And I argue that this is just wrong. I argue that people like Adam Smith, David Hume, their contemporaries, lived in a period in which not only was religion more central and more pervasively important than anything we know in the Western world today, but the religious thinking of the Western world, especially the English-speaking Protestant world, was undergoing its own major revolution at this time. And this controversy over religious thinking affected the thinking of Smith and Hume. So I argue that right from the ground level, what we think of as modern Western economics was powerfully enabled by these new currents of religious thinking.
Was it just the liberation of people being able to think out of the box because people were thinking out of the box about religion?
No,
Or
it was more specific than that. The English-speaking Protestant world had become dominated by the thinking of John Calvin, arguing that people's spiritual destiny was, to take the Calvin word, predestined, that whether you were to be among the saved was determined not only whether you individually were to be saved was determined not only before you were ever born, but before the world was even created. So it followed that nothing you could do, nothing you could say, nothing you could decide would have any impact on that. And by contrast, this was just the period, and I document this in some detail. I mean, as you are well aware, I didn't grow up in a Presbyterian Sunday school,
Right.
so I had to learn up on this. The new view was no, that's not correct. Everybody has the possibility of being saved, and moreover, whether you're saved or not depends on your own choices, your own actions, your own decision. And I argue that what Smith and Hume were doing in seeing the possibility for markets and economic decisions was secularizing this new line of optimistic religious thinking. That Smith was all about, look at what can happen if we let people acting on their own in the setting of competitive markets do what they choose to do.
So you act the right way, you get into heaven. You act the right way, you get rich.
But not only do you get rich, it's that you make other people better off too. The fundamental idea, what you and I call the first fundamental welfare theorem in economics, is that if you and I pursue only our self-interest in the setting of competitive markets, we will make other people better off as well. So if you think about it, against thousands of years of thinking about the dangers of self-interested behavior, that is a very powerful and startling thought.
So it's really in a kind of in a short phrase, it's that it's not a zero-sum game.
That's correct. And human nature is not perverse. Human nature acting on its own. You don't need people to tell you, hey, Larry, you better look out for Ben. Hey, Ben, you better look out for Larry. You're pursuing Larry's interest. I'm pursuing our interest. And through the working of the competitive market, and that's what Smith's second book, The Wealth of Nations, showed us, we make each other better off. This is a very powerful thought. And I argue that it's religiously inspired.
Would you say that it becomes a religion itself?
It might be, yes, well, one could make that argument. I don't, but there's nothing in my book. There is a guy who alas died. I don't know if you knew him, Bob Nelson. A very interesting guy. I got to know him quite well before he died. Bob Nelson has a series of books about economics in which he makes exactly the point that you make. And I view my book as different. Bob and I talked about it. Nothing in my book would contradict what he and you just said, but that isn't the argument of my book.
Cool. So let me bring this to a close. This has been a fascinating conversation.
Thank you. I've enjoyed it.
Ben has 14 books. We could, become fully educated about history, about economics, about politics, about policy from just reading those books. But then there's a whole slew of articles. But just, obviously not everybody has that amount of time. But I do want to impress people on the idea that if you really want to get a good background on history of economic thought, this book and the players, this book is for you. It was just, it's really hot off the press, only a couple of years old, and Religion and the Rise of Capitalism. And then again, the moral consequences of economic growth. It's a major rethink of how societies work and when they stop working, and how that connects to economic progress, and how the lack of economic progress can further impede economic progress as people start fighting over the lack of economic progress. This has been fantastic. Ben, thank you so much.
Larry. You and I enjoyed sitting and talking to each other and arguing with each other 50 years ago, and I think it's great that we're still at it.
Yeah, we're going to keep at it. We're just starting out. Come on. So
we'll go for the next 50 years.
Absolutely. Thanks again, and thank everybody for listening. And please spread the word about Economics Matters, the podcast and the newsletter, and anybody can contact me and get a free lifetime subscription.